All right, good morning, everybody. Green on the screen around the world, but how long will it stick? Japan punted, said they're not interested in shaking the tree when it's already shaking. The China ADRs are up just a little bit, 0.5%. Uh, kind of expecting the Dow to get hit a little bit with the names in there that are having earnings. Japan up about the same, 0.75%. The S&P above 1% again. Pretty nice when we get it. NASDAQ at 1.25, but it's topping out. Small caps making a nice move. Keep an eye on those heavily shorted names. See if we get a small little move in that space, right? Like a short covering rally, a short squeeze, something like that. Would be nice, right? Just 1 or 2 day play. Take what we can get. Consumer credit. This goes to what we've been hearing a lot, how people are dipping into their savings more. They're heavy on the credit cards. The consumer is tired. We'll see. We have auctions today, and I, I often feel like a little bit of a lone wolf on these, where I beat the drum and say, watch the auctions. And it seems like I'm the only one that ever mentions these darn things. Some are more important than others. And today is the 10-year. It's at 1 o'clock. If you see an auction on the day, it can be at 11, 11:30, or 1. And so if you see an auction on any of those time zones, just assume there's going to be auctions on the other time zones. So if this one is at 1, go ahead and make the assumption that there's some auctions at 11 today and at 11:30. And just because you don't see any listed here doesn't mean anything. A lot of things don't get listed, like QRA, for an example, never gets listed. And we all know how important and impactful QRA is. If they don't list that, what else are they not listing? Watch the clock, right? It's the best indicator you could put on your chart for intraday trading. What time is it? So after 1, we're pretty much good to go into 3 o'clock. And then tonight, because of Japan, if you're trading in the evening, you should get another chance to enjoy some volatility. It's been really nice this week. If you've been trading, in the after hours, we've had some really great moves. You're very likely going to get a chance again tonight for those kind of moves. So, if the day today is looking pretty nasty, just want to call timeout and come back later tonight, you know, save your energy. $53.50 is going to be difficult to get through. This is a weekly profile, and we can see last week's profile right along this low that we built Friday afternoon. High volume node. Just getting through this zone is going to be really difficult. And there's a gap that needs closed there. So maybe we can get the gap closed right at that 53.50 area. But getting through this high volume node in the first shot, it's going to be a little harder to do. Got a couple of positions on I need to manage. Just a second. Get some stops in place. Normally I would have these closed already, but I waited too long for them to set up, so I wasn't going to give them away. All right, we're good. So manage that area if we come to it. I don't think we're going to be able to get through it yet. Everybody's been talking about how, oh, that sell-off was just an overreaction, and now we're running back to the top. Everything's okay. Goldman Sachs and everybody else saying, buy the dip. This is a great dip. You should buy it. It really feels like they're saying, I want to sell a bunch of stuff. You should buy it from me. Right? I don't know if I'm the only one who's getting that warm, fuzzy feeling, but it sure does feel like they just want us to unload their book for them. So sure, I've been cautiously shopping along the lows like everybody else, but don't think for a moment it's just going to be a nice smooth ride back up to those previous levels. We're underneath all of the averages, and we've got a lot of high volume nodes and profiles and pivots and gaps and everything else as resistance to work through to get back up to where we were. And like I pointed out, like 2018 and other years where we didn't really have a bear market per se, we didn't sell off, it wasn't nasty or drastic, we just didn't go anywhere either. We solved the missed daily pivot, the MDP problem yesterday, tagged the pivot after 2 days of not hitting it, cut through today's channel is above yesterday's channel and it's wider, implying that we could fail to break out if a breakout is attempted. The market's very likely going to go into a sideways mode as we get closer to the end of the day, waiting on Japan. Unless they come out flexing again and talking more about what they're going to do before they do it. That could kind of kick the market into gear. But it's been a sideways, right? We set that high yesterday and we're just sitting in the zone now. It's very likely we sit in this zone for the rest of the day. We're already at the upper ADR yellow. A lot of times we're barely to the red at this point. And the phrase is, if we get to one side early enough, we could go to the other side by the end of the day. We're already at the yellow. So we could certainly go to the other side by the end of the day. I don't expect that we would go all the way to the yellow on the other side. I think that's a bit much. But it wouldn't surprise me if we get down to the red one, right, at 51.95. But I think it would take news to do that, right? There's some key levels here, 5,300. We're at the cog line, 53.32, but there's 53.11, 52.91, 52.50. The voodoo line here at 52.45 or 46. So there's a lot of structure underneath this that would make that sell-off difficult. But holding the line and staying between that voodoo line, that green line, and the yellow, and just chopping here all day, or even just staying inside of yesterday's range, I think that's completely on the table. The 10-year could break us out of this zone, but that's in the afternoon anyways. And of course, some earnings could do it. But otherwise, look at this and think, well, what's the catalyst? What would give us that play? And it's hard to imagine what's on the table right now that could give us this breakout that we need. It's the same argument we had yesterday. We're not seeing a market maker move yet. I would be watching for that as we get closer to 1 o'clock. Because if they start getting nervous about the 10-year, you should get nervous about the 10-year. It's a pretty simple concept. Thinkorswim has an issue with TNX, so I can't bring it up. I don't know what that problem's all about. So I just use the 10-year. We can see it's up this morning. Gold's down, dollar's down, under the 10 on both of those. Now, the dollar, it's down off of that peak, right? Had an inside day breakout, failed, came back in. We want to see it get underneath this 3-day. But really, the dollar underneath that 104 is kind of a load off on the markets. So with the NASDAQ sideways, the ES sideways, US dollar Japan sideways, it really just feels like we're waiting on data. But reserve that caution for a market maker move, right? If we start to see that, then you'll know that they're nervous about the 10-year. We got the founder's note early this morning, which is nice. $52.31 is a cog line. It's also where the put wall is. We tested that level yesterday and it held. We saw buyers stepping in there as we should see, right? That's what we're supposed to see at that level. Still don't have the gamma levels underneath us. Keeping an eye on those to see if they get rolled down or changed, or moved. Just a second. All right, we're good. We got the 10-day overhead, the 3-week overhead, the 10-week, 20-day, really everything, all the moving averages are overhead on the daily that we would be focused on. The only one that isn't up there is the 200, and that's because we bounced off of it. Question is this a dead cat bounce where we just lift up off the lows, set a lower high, and continue to the downside? Or is this it? Are we done? Now, I've been making the argument when we started the pullback that we were looking at a normal average 5 to 7% pullback. It's what we would expect. Now, we overshot that quite a bit. There's been a lot of speculation on the aggression of this move, how fast it happened, and the rate of change. But at the end of the day, we're already popping back the other direction, and these sell-offs, they can get violent, right? So 10.5% instead of that 5 to 7%. If we're still looking at just the typical regular pullback, then we just overshot the average. Instead of 7, we got 10. If you look at the last time back in April, when we had that 5 to 7% pullback, we digested for a while before we even got back up to the previous high. And then we had to digest that for a while before we finally started to work our way out. It took time, right? Months. This is a much deeper sell-off, and I think they scared a lot of people on this one too. So, not only did we go farther, freaking everybody out, it could take a long time just to get back up to that 5,500 area, let alone, get back to these highs. Yeah, it's certainly got the possibility of a massive head and shoulders forming. But one, if it's really that big and wide, it's worthless. Two, if it's on the daily or the weekly or the monthly and it's that big and wide, then it's really worthless. So I wouldn't get hung up on, that big old head and shoulders. And, it's the butt of most jokes, that if the only thing you've got for your analysis or for your trade is that it's a head and shoulders, you want to leave it alone, right? Because it's the worst performing popular pattern out there. It's hard to understand why it's so popular when it's so performance is so bad on it. Intraday, I'm much more willing to entertain a head and shoulders pattern. And the cleaner the pattern, the tighter the pattern, the better it is too. So we do have some key metrics from a pure price perspective that has to be taken into account. This high right now is the line in the sand that we have to get back above and get through. If price works its way up here and fails to match this high or get a better high, then we're going to have a lower high. Now, a lot of analysts will discount this and they'll say that that wasn't a lower high. It's debatable how far up we rose from this low is the argument on whether or not we can consider this a lower high. Let's just discount it for the moment and say it wasn't one. This is our lower high then. We have to match this high or get a higher high or else. It's a pretty fair statement, or else. But that would mean we need price to fall away after rising. And so far, we haven't gotten out of that last candle yet, that last red candle. There's a thing called CAHOLD, CAHOLD, candle at high of low day. This is the last low day. That is the high. The CAHOLD would be a breakout buy when you get past that high. Thinkorswim, Connie Hill and Barbara, shoot, I forgot her last name. These two ladies were really great at doing videos on the CAHOLD pattern. If you hit YouTube, type in, Thinkorswim, CAHOLD, they had candle patterns made that they shared with people, because you can load your own candle patterns into Thinkorswim. Indicators that they made for it, scanners so that you can scan for stocks that are setting up in a CAHOLD pattern. Check it out. It's pretty good stuff. I know Thinkorswim isn't owned by TD Ameritrade anymore, so I don't know if those ladies still work with that broker, or did they get hired at Schwab? I don't know. James did, and a couple of the other guys, but I haven't seen the ladies, so I don't know. So we can get this breakout started, get the lift up, but we still need the pullback. And the pullback at this point, that's a really tall order, right? We need this market to run all the way up to 5,600 and break through that level without falling away. That's asking for a lot. So it's very likely not going to happen, right? We're going to end up falling down before we get there, and that'll set us a lower pivot, a lower high. And at that point, we'll still have to watch this low because we don't want another lower low, right? We've got our low set here. We've got our low set here. That's two lower lows. If we don't count this as a lower high, then we wouldn't count this as a low, right? We just count that as one shot and then a pullback and then one shot. So one thing you can do is focus on the candle, that CAHOLD candle, the last big drop. All right, I'm flat. We got our 50% mark, 52.32 cog line. Got our liquidity zone at that 111 area, call it just a sell zone sitting up there. If we can get through that, then we can focus on the half back of this day, which is already lined up for us at the 1236 or around number 5,400. We got to get through it either way, and then try working our way back up. But we can also measure this entire leg and see where the 50% mark of that is. 53.60 is that half back. And it's basically the close of 8-2. So, you know, without having to do any of the math and working things out, it's just one of our pivot points. It's a daily close. Mark that as the half back level. And then, of course, you can measure the entire thing and mark that 50%, but that's a long ways away anyways. No reason to clutter up the chart with extra lines and levels. The NASDAQ rolled over off of that 62 level. So it hasn't given everything up yet, but it's looking like it wants to keep its boundaries and that we may not get to that yellow line, the ADR side. So from a pure price perspective here, we've got our work cut out for us. We got to get this high up here. And then when I think we're going to get a lower high. When we set that lower high, we've got to maintain a new low that's higher than this low, right? And kind of, we're basically trying to rebuild this. So we're looking for the run up that fails to get back to the equal highs and the fade. And then in this fade, we need it to stay higher than the low that we already have. Same setup, right? It's just a much wider setup, but it's the same thing. Hopefully that gives you some context in what we're expecting, that it's not a straight shot, right? That we're going to have to digest. There's some work to do. And in high volatility, volatility is just a word for movement. So high volatility is just another way of saying big moves. Markets aren't going to respect their expected moves. They're going to exceed it, travel beyond it. Even sideways days like we had yesterday, it was a really big sideways day, moved 100 points, but it was still a sideways day. That was a perfect rejection on the yellow line, by the way. If you're not watching those ADR levels and you're day trading, you're missing out. Yesterday, we talked about 5350 as the area for the new point of control. It's the likely area. As we continue to lose candles through this zone, which will happen in the later part of the week, this volume will fall off and this will no longer be our point of control. Where's it going to go? We're going to already have these candles gone, so a lot of this volume won't be there either. Some of it still will, because we have this zone. But it's very likely that 5360, 5350 area is going to be our new point of control, especially if we pop up into that area and we get a lot of selling there, which will add to the volume. The TPO isn't in agreement, by the way, right? There wasn't a lot of trading here. There was just a lot of volume here. It's a really nice wedge, by the way. Rising wedges generally break to the downside. But when it comes to rising wedges, you'll oftentimes get a blow off top. So that often looks like a big fake out and then a break to the other side, right? It doesn't owe us a blow off top, nothing like that. Just it plays out that way quite a bit. Think of it a lot like a raid and a draw. The thing about a rising wedge, though, if it's a good one, is it shouldn't get too close to the apex, right? So what I mean by that, let's just draw it over here. If you've got that rising wedge and you've got price action inside of it, it generally doesn't get into the last 30% here, right? It doesn't tighten itself up right into that corner. So that 30% zone is kind of a warning. If price does get into that zone, then we're not going to see a typical rising wedge response. It went too far into that area. You would think it would be a good thing. Lots of compression, a tightening range. It's getting smaller and smaller. It's winding up more and more energy, but it doesn't play out the same way. So it's been a little bit of a tell over the years when I'm keeping an eye on a rising wedge. If it gets too deep into that apex, then it's not going to move like a typical rising wedge would. We didn't hit any of the VPOCs yesterday, and we don't have a new one today from yesterday. If we were going to put it on, it would have been right at this level, and we've already hit that level. So it wouldn't be a VPOC. We did see a response out of price there, and it is yesterday's pivot. The textbooks would tell you to carry that forward and use it. I'm not disagreeing with that. I just already have enough levels to monitor. I don't need another one. So I only mark the ones that haven't yet been hit. But if you don't have enough pivots and you want another one, that would be a good one to keep your eye on. Price has already shown us a couple times today that it's paying attention to that level. It's also worth noting where the greatest amount of volume is today. It's up at the highs, and that wasn't where the greatest amount of trading took place. It's close. We're building it out pretty good, but there was a lot of volume up there. So now that level is over our head. It's going to act as a resistance once we get far enough away from it. Remember, if we're just chopping within this zone, then we can just keep crisscrossing it back and forth. But if we leave the zone and then we try to come back to it, then it'll be a resistance. So until we actually leave the range, I wouldn't try to count it as a resistance, and I would expect price to continue to get up and down and through that level. And if we travel above it far enough and come back, then it'll act as a support. But right now it's not. It's just going to be a magnet. We're still 2% below the 10-week. We haven't really changed much there, which makes sense because we haven't really gone anywhere. Still hanging out, which is fine. We're kind of at that level that we would want to be. Look at the April pullback for an example and where we were at that point. So a good 2% away from the 10-week. It's just fine. It's exactly where we want to be. At this point, it doesn't necessarily mean that we're going to go back to the 10-week. We can just hang out here and the 10-week will come to us. So sure, we're going to work on getting back to that 10, but we can correct in time rather than correcting in price and just let the 10 come to us. For the 10-day rather than the 10-week, we're already on our way back up. We're still underneath it, 1.4, just call it 1.5. We got a little deeper than we've seen in a while. It's a lot of the rate of change and how fast we moved in that dump that kind of freaked everybody out. But we've already come back in the other direction beyond the average low, right? So the average low is around that 2.1 area. We're already back at 1.4. So we've certainly rebounded the other direction. And on the day that we were falling that deepest fall, I pointed out what we were looking for, right? This kind of pin bar recovery day. And we didn't get as good of one as I would have liked to have seen. Those ones where it falls down really deep and then it rallies back up, crosses our own open, and ends up green on the day. We didn't get that, but still, we got the same kind of candle that I pointed out as what we were looking for. So far, price is doing exactly what it's supposed to do. It was a little more violent than we expected, and the recovery wasn't as solid as we would have wanted, but that last hoorah to the downside, that kind of a capitulation low, and the flip and the rally back up, it's all doing exactly what it's supposed to do. So we're on schedule at that point. There's another one where it really wasn't a fantastic recovery, but it's the same kind of capitulation low. The thing is, and this is what has everybody kind of worried, is we're still stuck in that last candle. We haven't gotten out of it yet. We're holding above the 50, and that's good, which is a cog line too, by the way. I love those things. But if that level breaks, it's game on to the downside. We're still not seeing a flight to safety. Utilities are flat. Healthcare is negative. Staples, I mean, they're barely up. If this was a flight to safety, we would be seeing these lower sectors getting a lot of flow. Now, granted, this is a change over a 5-day period, but we've been selling off long enough now that it should have registered. There is a concept that says, in times like this, everything's going to fall, but maybe defense will fall less. And certainly that looks to be true when we see what's on the screen right here. All these other sectors, these other 6, they're down much more, right? Tech is down over 8%. Consumer discretionary, almost 8%. So sure, defense didn't fall as much as the others. It's why they're defense. But where's the capital rotation into those sectors in that flight for safety that we would be looking for? And if the Mag 7 is going to take a breather for the last part of this year, and we're going to see a resurgence in things that hadn't been getting money flow, then we should be seeing money flow in those things. And nope. It's broke. We gotta wait. Sometime today, sweetheart. There it goes. Poor Thinkorswim. I work it too hard. The VIX is down 15.7, basically 16%. So it's normalizing, getting back into where it should be. These levels are from David Keller at Stock Charts. His video was it was a nice, concise little summary with simple, easy levels, and I love it. So I threw it on a chart. We can see that the violence is really abating rather quickly. There's been a lot of discussion about this move. It was the biggest one-day move in the VIX in quite a while. I can't remember the last time it happened, but it's been a while since we've had such a one-day move. And apparently a lot of it was shorts covering. So, they added to the buying, and it was just like a short squeeze in the VIX, which sounds funny, but I mean, that's from Bloomberg, right? I don't know, take it with a grain of salt. But we are dropping back down again. The thing is, though, are we still in backwardation? So here we've got the volatility watch list. And you can see I've got it set from August, September, October, November, December. So they're in line. If we were in contango, which means if we were in normal volatility levels, then the front end would be low and the back end would be high. And as you go farther out in time, the numbers would get higher and higher. Uncertainty resides in the future. There's just so much unknown ahead of us. War, a new president, drama on the world stage. There's just so much unknown that's in the future that volatility farther out in time is usually higher than where it is closest to us. That's contango. When that swaps, it's called backwardation. It's when the front end is higher in price than farther out in time because investors are more concerned with their immediate market environment than they are about the possibility of the unknown future farther out in time. So it doesn't have to be as complicated as it sounds with those big fancy words. Backwardation just means the VIX is bid up in the front and farther out it's not. And contango just means we're in normal market conditions into volatility. If you don't have the VIX futures, you can use VIX with a number behind it. So VIX 6-month, VIX 3-month, and then just straight up VIX. That's a 1 month. There's also a 9-day and a 1-day, but I don't use them. I just stop at the 30-day. So 1 month, 3-month, 6-month. There's a year you could put on there as well if you don't want to use the volatility futures. So the VIX is down. It's not a surprise. It's got a lot of work still to do. It's still up 25% from the last 5 days. Even with all of the falling that it has done, it's still up 25%. Looking at things that are up, what's triple leveraged semiconductors, the Mag 7, Nat Gas, which is a joke. Mess with that. Emerging markets, that's basically China. More semiconductors, uranium, technology, China again through the KWEB, so their internet ETF, gold miners, more Mag 7, energy exploration, more China. Financials are up, the banks, and they were up yesterday. They were getting some good flows yesterday. More generic XLF financials are up, biotech. If you're still shopping for, some bottom fishing plays or just, some cheaper stocks that are making moves, biotech's been good this year. It's not a space I typically play in because I don't understand that stuff at all, but it has been a good year in biotech. More Mag 7, solar, communications, industrials, everything else is up, right? Our benchmark is 0.5%. It has to be up at least that much. And that's because we're doing the morning briefing so early. If you're doing this yourself closer to 9 o'clock, I would recommend increasing that benchmark to at least a 1% or 1.5%. When you're looking at things that are up or down in the pre-market, you're trying to get ready for the trading day, and you're doing it closer to the open, demand more out of it, right? I'm using 0.5% because we've still got, another hour and a half to go for the open. That bond short is working good. I covered a lot of it yesterday. At the meat of the move, you know, I'm not interested in trying to wipe the plate clean. Do I think there's more in it? Yeah. I mean, getting back to 94 shouldn't be a problem. Even getting back to the year-to-date anchored VWAP shouldn't be a problem in time. But I think this easy move is just about done once we get back to the open of this big green bar. Right, then it'll be a lot harder, I think. I don't think it's just going to stay red, red, red all the way down without another fight. Nat gas is the one that's up the most on this list, and it's trash. It's been trash. This is a classic example of how to trade a bear market. If you want to go in and play some of it, I don't want nothing to do with this thing. But yeah, whatever. Crude is up. It's Wednesday, so we're going to get a report at 10:30. It's the petroleum status report. So if the ES and NASDAQ are kind of nasty today, if they're not behaving and staying sideways because we're waiting on data and you're looking for something else to play, crude may be a good shot around 10:30 when we get oil. It's not a bad way to go. Don't forget orange juice. Chocolate's been really beat down. Maybe go in that direction, right? It's cocoa futures. I know nobody can afford it. It's too funny. So emerging markets is basically China. This is really aggressive pop. We've seen China up the last few days, but it was still stuck within its own candles. This is over the hump, over that VWAP, complete inside day breakout, really nice expansion. Just remember that emerging markets is a gappy bugger. It moves a lot in the overnight, not much in the intraday. Semiconductors, red to green on this close. This is a really good setup if we can get it. All right, so not only did we get the pin bar reversal, the rally back up, and then the pause, the rejection off of the VWAP, and it fell all the way to the low of the day and closed there. It held above the 50% of the rebound bar. Right, so I need a better word for that bar. I'm sure there's somewhere in the textbooks they have a better name for it than the rebound bar, but that's what we'll call it. It held above that 50%, closed at the low. Now the sweet spot is today. So we got the rally up in the overnight and it ran all the way up and it got above yesterday's open. It's a good start. What we need in the pre-market, or what I'd like to see, is that it actually gets completely out of yesterday's range before the open. And then it uses yesterday's high as support so that once we do open, it falls back, checks that support, and then continues the run to the upside. Otherwise, the problem is if we just rally up to yesterday's high and we've already broke out, but we failed to keep it. If we can't get out of that before the open, once we are open, it will be a significant resistance level. In the pre-market, we can jump things like that, right? Pivots that are in our way, resistance, we can jump them in the pre-market. But once we get into the open, it's a much more significant level of resistance. And that can hold us back and we end up falling back down again. And this ends up being a lower high. Right now, it's not a lower high because we're here this morning. If we had continued to sell off underneath yesterday's low, then this print would have been a lower high. If we fall today without getting this breakout, it's going to be a lower high. So want to see semis get that breakout. We could just chop here for the rest of the day, right? I'm not saying it has to fall, just that if we were looking for a continuation and a follow through, well, we're not getting it yet. And that's what we need. But yesterday's high was also that year-to-date anchored VWAP. Perfect rejection off of that thing, by the way. Just, you couldn't ask for it any better than that. But now that's the line in the sand that we have to get through. And without semis, how much of the rest of this rally could we expect to keep? Uranium putting in a nice bear pennant. I would focus on getting this gap closed and then getting above it. If we fail to get above it and close above it, we're very likely just setting a lower high and we're going to continue to fade. If we can get above it, it kind of opens the door that we could come back to that VWAP. Just because of the scope and the pace and the speed of the drop, right? China again, nice breakout. A nice bounce off of that VWAP. But I don't think we're done. Right? It's possible, but I think we come back and test it again. Still for this morning with the China up, you've got Baba, Baidu, JD, PDD, XPEV, Neo, EDU. Got a lot of those China names that should be getting some good love this morning. I don't know that I'd necessarily want to swing them, but nothing wrong with a day trade. Tech is up, but it's still inside of yesterday's range. We got to get that inside day breakout. And even if we get the inside day breakout, we're underneath that year-to-date VWAP now. So it's going to be a resistance level. Yeah, a lot of resistance on the K-Web to the upside. Just a lot of trash to work through. Still, I mean, if you can get an inside day breakout, which we got, and a follow through, then, we could get back to that anchored VWAP. It's still just saying, those China trades are just going to be a day trade at the moment. I wouldn't expect anything more out of it. Still, everything is up, right? Everywhere we look, everything is up. There's a metric I don't do much anymore after TradingView changed some things around, but you can go into TradingView and look at this heat map. Now, hear me out. I know it looks really silly. And when I was new, I would look at the heat map and I think, what a waste of time and effort to even code this thing. Not going to waste my time looking at it. And I was completely wrong. It's a great way to take a look at a lot of names all at once. We've got the S&P 500 here. They don't offer an S&P 100, so I have to do this. So now I've got 88 names. It's not the S&P 100 perfectly, but it's the highest names by market cap. So we'll just do it that way. Once you got that, you want to adjust it a little bit. So come up to the top where it says this 1X and adjust it so that we're at least 0.5% or more, right? Let's go. Actually, on this one, it looks pretty good. We don't need to adjust anything, but if we did, we could use this one, right? Or let's just put it back. I don't like it. So 0.5% is where it's going to start changing colors. And at a glance, you can see the bigger the box, the bigger the market cap. And so the Mag 7 stand out. Meta, Google, Microsoft, Apple. Like what's moving in the pre-market, what group, what industry. So it's a nice snapshot to see, what's moving. That's the S&P 500, but you can just use the NASDAQ 100, same kind of approach. You see the semis stand out, Mag 7, not Tesla. Although Tesla's not really down all that much, 0.25%. I mean, for Tesla, that's not much of nothing. I have mine saved on the old screener. That's why I don't come in and use this one anymore. I've got a screener that looks at the Mag 7 and then another one that looks at the NASDAQ 100 and then the S&P 100. And what it's looking for is how many names in the pre-market in the S&P 100 are up and how many are down, by what percent. This new screener, I don't have my setup for it. On the old screener, I do. That doesn't do us any good. So we can do it this way. Pre-market gap above or equal to 0.5%. 44 names are up in the S&P 0.5% or more. 44 is not very much. So if you're thinking, wow, it's really bullish this morning, not overly bullish. We can see one utilities name, a few transportation, and then we've got, these are the ones we need to see: technology, finance, consumer discretionary is what I was looking for. I don't see consumer discretionary, but we do have electronic technology and tech, finance. We want those, right? If we're looking for a good rally, we don't want it to be in defensive space. So that's the ones that are up. On the ones that are down 0.5%, 2. So 44 up, 2 down, at least 0.5%, and then everything else is just in the middle. Swap that to the NASDAQ, things that are up at least 0.5%, 40 names. So again, not overly bullish. It's a broad spectrum of things that are up this morning, but while the sectors are up enough that we were able to highlight those sectors, when we look into the names, there's not a lot of names up. 44 names out of 100. That's not even 50%. So temper that enthusiasm a little bit. We want to see a lot more names. On Thinkorswim, you have the Visualize tab, and you can use just your basic advancing minus the declining issues, but I like this one better because it has the money flow. So Market Watch, Visualize, get rid of the heat map, change it to the index, choose which index you want, and you can load the Mag 7 if you want to. You can load more than one of these because you can detach them and stack them. Set it to the NASDAQ 100, and once we get into the open, you'll be able to see how many are advancing, how many are declining, and then the money flow, which is really nice. So you can keep track of that. If it's going to be a bullish day today, it's either going to come from a 0-day push, or we're going to need that rising tide scenario, right? We want to see a lot more names or more out of the names that we've got. Watch the clock. Keep your eye out. We're looking for them to start hedging before the 10-year. You'll see a market maker move start to show up. If you're on a broker other than Thinkorswim, you don't have market maker move, but you can see it. I'll show you where to look. You go to the options chain on whatever broker you have. It has to have options. If it doesn't have options, you can't see the market maker move. And you want to look at the front expiration. So the one that says 0 days, that's the one up front. And you're looking for the front one to have more implied volatility average than the next one out. That's what a market maker move is. When the front number is bigger, You'll get a little label or a little tag here that says market maker move. It's in yellow, MMM. That'll show you that they're hedging. If we look at something else, anything else, there's a market maker move right there. The front series implied volatility average is greater than the next one out. So we have a market maker move. We want to be looking for that in, I like looking at it in the ES futures, because if they're doing what they generally do, they trade a ton of options in like the SPX and the SPY, and then they use the futures to hedge those options. Well, that's what we're looking for, is hedging activity. So I want to see it in the futures. If you don't have a futures data package, just look for hedging in the SPX, which at the moment has a market maker move, but we still need to open, right? So let that normalize once we get into the open and see if we still have the market maker move afterwards. I thought we had one all day yesterday. So this one can get misleading because of those 0-day guys, right? The way that this number gets calculated is from the out of the money options trades. That's what moves the needle on this. So out of the money puts, out of the money calls, heavy trading moves the implied volatility average, and it can jack it up. Well, 0 days, they'll go in here and they'll just YOLO a ton of puts at 5 cents and a ton of calls at 5 cents. And if it doesn't work, they don't care, because they only have to hit it once, right? Be wrong. You could be wrong 2 weeks, every day for 2 weeks, and then finally hit one and make a pretty nice sum of money on it. So that kind of activity jacks with this number, and you end up seeing a market maker move, even though they weren't hedging, they were speculating. So this one can be misleading. I'd rather watch it on the ES. We already know that the ES is their hedging product. It's not that they only hedge here, right? Just it's a certain kind of logic. So watch for the market maker move. Otherwise, look for the rising tide scenario. Keep your eye on the clock between crude at 10:30, the 10-year, and we're going to get some consumer data. It's going to be a bumpy day, I think. With that, be careful, be safe. I'll see y'all tomorrow.